Hello friends, this is Raj Sastry from Raj Option Trading. Today I will talk about strategies to sell put options. This is a quick segment here. Today is April 7th, 2021. With that, many folks have been asking about, hey, when do I sell put options and still make money? When is it safe to sell put options? This segment will cover some of those aspects and take it from there. And if you're very much comfortable with the put option selling, you can probably skip through first two slides. In the third slide or so, I will talk about the stocks itself, where you can sell put options right now. So with that, let's go into quickly a bell curve here to look at option volatility. As an option seller or an option buyer, you have to clearly understand what's implied volatility. In this example, we have a stock which is at $50, and we have the bell curve here, which talks about implied volatility. So when the stock is at $50, and if the stock does not move too much, in that case, it's a low volatility environment, and the bell curve is a little bit narrow, meaning stock really does not move too much, and the price distribution is within a narrow range. That's why bell curve is very narrow. So when the bell curve is narrow like this, you don't want to sell, you don't want to sell put options. So that's why we look at IV rank and determine where is the volatility for a given stock or even for a ETF for that matter. So key takeaways here really when the volatility is low and the bell curve is narrow like this, you don't want to sell put options because you'll sell put options maybe at 49 to collect a good premium, but when the volatility increases, stock price will fall all the way to 40 and you will lose a lot of money. So that's why you don't want to be selling put options when the volatility is low. Next, we have a one more bell curve here, which is yellow. So this represents a medium volatility scenario. Now volatility has risen from low volatility to medium volatility. When this happens, stock will move little more. For example, a $50 stock will move to 45 or 55 or in between. So at this time, if you're selling a put option, maybe at say 45 or 44, you will collect decent amount of premium because the market expects the stock to move back and forth, and that's why you are selling a premium and assuming some risk, and market will award for you. So it's a medium volatility type scenario where you can make some money. Think about IV rank, maybe around say 40 or 50 type scenario. That's when you'll make some money. But the downside is if the volatility further increases, you will end up losing some money. So the third bell curve here is really the volatility itself is increasing, increased rapidly. This typically happens during a market crash or a stock crash. Think about an earnings scenario. Stock really crashed really hard. At the time, volatility can increase for a few days because market is a little bit uncertain, and then it will kind of cool off. So when the market sells off drastically, or even stock sells off due to some expectations or some headline news, that's when volatility will increase. A bell curve will be something like this, which is expanded. At this time, you will have a bigger range. Even though stock price is at 50, market now expects the stock to move between 40 and 50 or even beyond that. So at this time, your chances to stock really fell off the cliff, volatility expanded, the RSI or relative strength index, if you make sure that's low at this time because stock sold out. So in this scenario, even though stock price is at 50, you can still sell a put option at say 42 or 41 and still make a decent amount of money. And your outlook is positive. Your stock fell off, relative strength index is low, you're hoping the stock will move up and you can keep your entire premium. So that's your strategy here. So in a nutshell, without going into too much detail, if you're a put option seller, look for high IV rank or high implied volatility rank, and also make sure stock is kind of sold off, meaning the relative strength index is low. So those are the two things you need to watch out for as you sell the put option. Now let's look at a quick example here. I will not drain through the slide here. So this talks about a quick chart here. We got a stock ABC as an example. Right now stock is at $40. As a put option seller, you have to make sure you are selling a put option when the IV rank is high, maybe around say 30 in this example, because you don't want the stock to reach 30. So when the stock is at 40, you are selling a put option at 30 and collecting $2, or in this case for one contract you are collecting $200. Your hope is stock will stay above 30. It can go up, it can go down up to say up to 30, or it can stay flat at 40. All the three scenarios you will make money. So that's your hope. So you want to make sure volatility is high when you sell the put option and stock is kind of oversold, so you're hoping for a bounce. So at the high level, you have a bullish outlook. Your risk is unlimited, meaning if the stock goes to zero, that's the maximum amount of risk that you have. You will lose your money. You will end up buying the stock at strike price, in this case 30, even though stock goes to zero. That's the unlimited risk that we are talking about. And your maximum reward is really the premium that you received. And you got to make sure you sell the put options with the 45 or 50 days to expiration. You don't want it to be like too much time left. So time to expiration should be around 45 to 50 or lower. And you make sure there's a clear area of support. For example, if there's a good level of support around 30, you want to basically sell just below 30. So you got to make sure stock does not go below the strike price that you're selling put option for. And the theta decay is your friend, meaning as the time passes, you will kind of market kind of expects now it may not fall too much. So the amount of days will decrease as the time passed. So the probability of stock reaching your strike price is low. That's why you'll kind of see your profit increasing as the stock stays the same or goes up and the time is decreasing. So with that, let's jump into some of the stocks that you can sell put options. So we'll go through a couple of these here. These are the stock here. I will not go through in very detail in this slide. We got Fate, Therapeutics, Intellia, BioGene, Vertex, Futu Holdings, Illumina. You can run through this. Just pause for a minute and look at this a little bit. The way I selected these stocks is really the implied volatilities rank. You can look this up in thinkorswim platform very easily through the scanner. You want to make sure the IV rank itself is high. I want to really make sure IV rank is at least 50 or more. So that way you are looking at a bell curve which is flat. And you want to make sure the RSI, or the relative strength index, is relatively lower. I prefer this to be 50 or lower, so that way you got a good chance for the bounce back. But at times you got to look at the trend of the RSI, and you want to make sure the trend wise it's kind of bouncing off from a low level to a higher level. And the IV percentile also, as you look at the IV, you want to make sure the stock is at a high IV, and your expectation is IV will decrease as once you sell the put option. So that way you make money. You sell when the IV is high and you buy back when the IV is low. So that's why you kind of make the money. And I want to make sure the company has got good revenue growth. As you can see here, many of these companies have got positive revenue growth. That's one thing you want to make sure, because ultimately, if the stock drops to your strike price, you will be buying the stock. So you have to think through as if hey, what, you're going to buy the stock in case something happens to the stock and it falls off the cliff. Of course, you have other options to roll. You don't need to really buy the stock. You can roll the stock. But sometimes, buying the stock is also a good idea, because it typically it bounces off and you can make the money that way, and you can also sell call options. So depending on your your portfolio size, you can choose to buy the stock if the stock falls and you got assigned, or you can roll the stock just before, maybe a week or two before the expiration. So with that in mind, let's go into some of these stocks. Let me go to Thinkorswim platform here. So let's first look at a stock called Vertex, VRTX. So Vertex, as you might be knowing, it's a pharmaceutical company. And as we see here, implied IV rank is 84 right now, which is relatively high. So we want to make sure the IV rank itself is high. And as you see here, RSI, relative strength index, is around 50. We want to make sure relative strength index is relatively lower, 50 or lower if possible. And as you can see here, the implied volatility itself, itself is high at this point. We want to make sure IV is high. I would not suggest buy selling the put option when IV is low, like right here or right here or even right here. You got to make sure you sell the put options when the IV is high. These points here, which right now it's also good. It's around 84% IV. So those are the two things I look for. I also look for, is the money flowing into the stock. That's a bullish sign. In this case, clearly money is flowing into the stock. And I also see the on the balance volume. In this case, on the balance volume is racing, which is a good sign. People are buying the stock. So with that, now let's go into the option chain here. I selected Vertex. As an option seller, like we talked about, we want to make sure we don't go beyond 45 or 50 days to expiration. By looking at this option chain, I got 37, 44. 44 is a good level here. I would choose 44 here. And Vertex stock price is 215, so I don't want to go at 215 because it can I can get assigned very easily. I will go somewhere around delta. As you can see here, we got delta here, delta 20 or so. I think this 195 is a good deal. You could go with 195, or you could even be a little more conservative and go around delta 15. That's what most people like to do. Delta 15 is very conservative. You can go 185. So with that, I can go ahead and here sell a put option here, 45 days out. So I will collect $1.45. With this, you got to make sure you have enough money and you got confidence in the this Vertex stock going up. So you could confirm and send. If you do it here, what you see is really your maximum profit is the premium that you collected. In this case, you collected $1.85. That's your max profit. Your max loss is really huge because this Vertex can go all the way from your strike price 185 to 0. That's why your max loss is 18350. That will account for 185 times 100 minus the premium that you collected, which is 185. So this is one of the reasons you got to be careful, unless you're very bullish. You have to be a little bit careful. Selling a naked put is a good strategy. You end up collecting the full premium. But if the stock tanks right now from 185 to say from 215 to say 150, what will happen is your buying power effect will increase dramatically. So instead of buying power effect, 1907, it will increase to maybe say 5,000 or 10,000. So that's why if you don't have enough money, you will get margin calls from your broker. So that's why if you don't have a good size of the portfolio, or even if you want to play safe, I would recommend going with a selling a put spread instead of put outright. To sell put spread, you can be a little more risk. You can take a little more risk if you want. So you could now go to 190 and sell a put spread. For example, if I go here, and if 190, as you can see here, the delta itself is 18 right now. So I could sell a put spread here. sell vertical. So I could sell a, say, in this case 185. I'm selling 190. I could buy back 180. So it's a $10 wide spread. So for this $10 wide spread, I'm collecting $1.32 and confirm and send. So my borrowing buying power effect now is reduced drastically. You can sleep in peace because if the stock crashes, the max that you lose is 868, not 185,000 like we saw, or 1800 18,000 like we saw earlier. So this is much better option for most folks because sometimes unforeseen events happen. You don't want to get margin calls from the broker. I think this is much safer to do. I would do something like this, for a for any stock. So you still collect good amount of premium here, 132, and this premium can you can collect the premium if the stock increases, and you can sleep at night peacefully. If something happens to the stock, your max loss is just 868. So this will help you to maybe know sell put options on more stocks versus doing the naked put option sale, which is risky. So that's one stock. Let's go look at one more stock here. For that, I will go to um, Futu, FUTU. So if you look at FUTU, if you look at the option chain here, before I go to option chain, let's go to chart first. If you see here, the IV rank in this stock is 59.43. Um, so as you can see here, one more way to look at the IV rank is, if you can go to trade and go here, and if you see current IV percentile, that shows the current IV percentile. So that's another way to look at it. So you could now go to the chart here and see here we got a nice looking chart with the future and IV right now. If I go here, it's a little bit low. You know what? I would not sell put options on future right now because IV was up here. Now it's kind of trending down. I would not sell put option here. Let's go to next stock, which is Fate Therapeutics. So Fate Therapeutics, I think this is okay to sell, put options. As you can see here, IV rank is 78.26. It's a little bit over here, which is good. And stock itself is kind of trying to bounce from a little bit lower levels. And check in money flow is telling money is kind of flew into the stock. Now it's on a downturn, which is not bad. And the on the balance volume itself is pretty solid. Money is flowing into the stock, relatively flat at this point. With that, let's go to option chain here. Same story, IV percentile 76%, we like it. And historically, the current IV percentile is 40. You got to make sure your current IV percentile is more than historic IV percentile, so that way you're in a better shape. So with that, let's go into option chain here. I would like to go 44 days out or 45 days out like we talked about. And I would go, stock is at 80. So if you stick to our delta 20 type thought process, we are looking at 65 strike price here. Or if you're a little bit conservative, you could even go to delta 60. That's also okay. So we will follow same methodology. If your portfolio size is a little high, you could sell a naked put and collect $1.75. If you do that, your max profit is money you collected 175, and your buying power effect is 692. Broker will kind of keep this money and hold it for for safekeeping, and the max loss is 5,825. So that's around your strike price, which is 6,660 times 100 minus the money you collected. So this is a good strategy, but if the market goes down below 60, your broker will collect more money from you as a maintenance amount. And if you don't have money, you'll end up sending the money to your brokerage account. Otherwise, you'll get margin calls. So other way to avoid this risk is you could sell a put spread. So you could be little, you could go do 65-55 put spread and sell that. So if you sell that, you will collect, in this case, $2.50. It's a $10, you're selling a $5 wide spread. This is a good amount of money to collect actually. So you could sell this, or if you want to increase it, you want to sell 65 and buy back. So 55, you will collect $2.70. I like the previous one. I think if you sell 65 and buy back 50, and if you collect, um, you're selling 65 and you're buying back, oh okay, this is too much, I think we'll do 60, not 55. So you're collecting, $2.50, which is good. So you'll basically, sleep at night. Your max profit is 250, your max loss is 250, um, and buying per effect is also 250. So I think this is a better strategy here. And if you're a little more conservative, you could even do a little, you can do 60, you can sell 60 here, and you can buy back maybe say 50. So this is a little bit conservative. You're expecting, the stock will not reach 60. Right now it's at 80, so $20, below the current stock price. And at 60, you're looking at a delta 16. So this is a little conservative approach. I would probably prefer something like this here. So if you do this, it's a $10 wide spread. You're collecting $150, and your risk is max loss is 850, which is really $10 wide spread here. You already collected 150, the remaining is 850. So that's the max loss. And you'll sleep better at night because broker will not take too much money away from you if the market crashes, because you basically limited by a defined risk strategy, the $10 risk max. At any time, broker will not ask for more than $1,000 even if the stock crashes. So this is a better approach. So with that, let's look at maybe one more stock, and for that, let's go to Fate Therapeutic. Sorry, ILMN Illumina. So if you look at Illumina here, so let's quickly look at the chart quickly. So by looking at the chart, you can see here volatility is around 46, and current IV rank is 43.82. I would not go with this because I want to see the IV rank a little higher. This is okay, but not great. I would think I would really like a little bit higher IV rank. So with that, let's go into one more stock. For that, let's look at um, BioGene BGNE. So BioGene, I think this one is a better one here. So BioGene has got IV rank of 66. I think it's a little bit on the higher side, which is good. And the RSI is 49. We want RSI to be lower. The stock is kind of oversold. So with that, if I go to option chain here, and also check in money flow is showing money is flowing in, a little bit stabilizing, and on the balance volume is also pretty stable. Money is flowing into the stock. So with that, if I go into option chain here, option statistics, current IV percentile is 64. It's higher than historic IV percentile, which is good. And if I go to option chain here quickly, I would like to go 44 days out, and stock is at 329. I could go around maybe 17 delta is good, 280. So if I do this here, I could sell this outright, just by clicking here. I would collect $1.55, but I would not recommend this because if the stock drops down, you'll end up owing more more money to the broker. You'll get probably margin calls. Instead, you could do a defined risk where you can do two, so right now 22 290 280 put spread. So if you do something like that, you would you'd bring in $2.15. It's a $10 wide spread here. You're selling 290 and you're buying 280. If you do this, you'll collect $215. Your max loss is 785, and buying power effect is 785. So I think this is much better strategy here because you're a defined risk strategy, and your risk is low defined risk. So with this, what you can also do from a you don't want to hold these till the expiration if you don't want to. When you make a good amount of profit, maybe 50% or so, you could sell this put option, go to the next stock which has got high volatility, and sell a put option or a put spread there. So that's the better idea. With that, let's go back to stocks itself here. These are the stocks. As I was going through, make sure you got good IV rank, and you got a little bit lower RSI, and then make sure company is solid. So with that in mind, this is the list here, and few key takeaways here. When you're selling a put options and collecting premium, make sure overall trend is up, and there is some temporary weakness. Maybe stock sold off, maybe market crashed. If you're looking at a ETF, then you got to make sure at least market has a temporary crash. Then you can get good premium by selling, put option on a, ETF like SPY or DIA or IWM as an example. Make sure IV percentile is high because this is when you collect more premium and your hope is IV percentile will drop off. Ensure the RSI is low, meaning stock is sold off at this point, and there is a good chance it can easily bounce back. And also make sure the earnings is not in near future, so that way when you're selling a 45 days output option, you don't want a earnings to increase the IV at a later stage, and thereby you will end up losing money. So you got to make sure earnings is not in the near future, and you're selling put options before the earnings or just after the earnings. And company has a good earnings and gross margin, and make sure you sell 45 to 50 days to expiration, not more than that. And close the position when you got 50 to 60% profit, and roll the losing position if the fundamental is strong, or if fundamental is weak, you can take some loss and close it out. Make sure stock has a good volume, and also the option has a good open interest. Ensure the bid-ask spread is not too wide. You don't want to trade put options on a thinly traded stock. And make sure sell the put options around 20 delta, or even like 15 delta at times. Selling put spreads to avoid high maintenance amount is as stock fluctuates. You don't want to end up in a situation you sold a put option, but then broker wants you to put more money into the brokerage account. You don't want to get into that situation too much. That's why if your account size is low, start out with the selling put spreads, maybe $5 wide or $10 wide. You'll sleep better at night. And during the sell-off, like for example, Dow Jones dropped by 100 or 200, S&P 500 drops. Try selling put options on major ETFs like SPY, DIA, QQQ, IWM, and also be careful and sell put spreads if your account size is low versus naked put options. And start with small contract size. We always say, as a stock market trader or investor, you always have to live for another day. Today stock might crash, tomorrow it might crash again. So the moment you sell these put options, like with a small contract size starting with one, you can sell next day also. So that way you don't need to worry too much about you don't have money or something along those lines. And also, if you sell the put spreads, your risk is defined. So you can sell one more put option spread if the stock or a ETF falls again. So that's why I recommend small contract size. And also, if you're starting out, start with the put spread versus naked put. So with that, happy trading and investing. Thank you very much.